Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, here's the dollar-yen over just the last month, and I want to show you an example of what I'm trying to talk about here. Over the last month, we went almost 5 points away on the daily chart. The price went almost 5 points away from the 62 simple moving average. We went almost 5 points away. And look at what happened over the course of the month. The pair made its way back down to almost zero. So it goes away from the 62, and then it comes back to the 62. It does this over and over and over and over again, that the currency markets are cyclical just like anything else. And in fact, they're probably more cyclical than a stock, whereas a stock can go to zero because the board of directors is a bunch of dorkwads, and the CEO didn't know how to calculate profits and losses. And the risk managers didn't recognize the difference between subprime, no doc, and prime and total doc loans. That's a stock can go to zero. And as we all know, Wachovia is probably going to zero. Right, Simon?
Yeah.
Simon's got owns puts on Wachovia right now. So all of you who can help out by, rosary beads, praying, or whatever it is that you do, just make sure you help out. And that's what it looks like, Dave. It just makes this decline. It goes above, and then it comes back down, and then it goes below, and then comes back up. And this is an example. This is a pound yen. You could actually build yourself a pound yen position in the options market by trading a pound dollar and a dollar yen position, or you could just stick to the dollar yen, which is a similar expression. This is just an example of a contract moving away from Main Street, moving away from that 62. As far as it goes away from it, Dave, eventually it's coming back.
It's coming back. Eventually it will.
Nothing will ever change that. Back to Main Street, so there it is back there. On average, most currencies spend most of their time around these moving averages. They're on the 62 on the daily. It's going to spend most of its time around there. Here's the euro dollar, for example. It's the EUI contract. And I love this one. This is so clean. 4, 6, 6. I mean, it's right around these numbers, isn't it? Look at this.
4 is a good number.
These barriers are, they're real. I know that this is the 62, this middle line here. And when price goes away from the 62, these ink blot lie detector test lines go, further above or further below. There's the levels again. And this is when you want to stand up and take notice. You want to trade shorter term? Do this on the 1 hour chart instead of the daily chart. I've given you the spreadsheets, so you could definitely do some of this data.
Figure it out from that.
Oh, absolutely, if you're familiar with Excel. Here's 2001 to 2008. On the top side, 4 is a barrier, just like we talked about. And look at recently, Dave. Look at how much more volatile the euro was a few years ago. It was so much more volatile a few years ago.
It's happier then.
I think that one. Okay. So it was much more volatile. Recently, even though we think of the currency markets as volatile, the euro has really sort of calmed down. It hasn't gone as far for as long, and don't think that won't happen.
Yeah.
Don't think that won't happen at all. You can see that the dollar-euro contract has spent a majority of its time below the 62 simple moving average. Why? Because the dollar's been trending lower.
Yeah.
Ruth asks, do you use the 62 simple moving average on 60-minute charts? Oh yeah, absolutely yes, Ruth. And if you're familiar with Microsoft Excel, make sure you jump on and you get that link. I'm going to put the link back up here again. There's the link again, robbooker.com/books/ISE_EUI.XLSX. And you can get the spreadsheet that was used to do all of this. Here's the dollar euro in 2005. You can see what it looks like closer up from April 05 to December of 05. You can see what it looks like. Look, it hardly can go below these levels or above these levels. It has a real hard time. What's happening there, Dave? Is the trend getting tired?
It's just a barrier.
Right, it's a barrier. The trend's getting tired. There's a point at which even the remarkably insane institutional traders that are out there, the guys on the desks that are just absolutely wickedly insane, there's a point at which they're not even willing to trade it any further.
Right. And it's where it's a barrier. Nobody's going to go farther than that. And
Right.
It's time to turn around.
Right. If you look at the COT report, for example, the Commitment of Traders report, these are the barriers at which institutions start trading in the opposite direction, and the dollar starts hitting the front pages of the news.
Right.
And it's exactly when you ought to be doing the opposite.
Yep.
Okay. Euro dollar 2008. Here's the euro dollar in 2008. It has spent the majority of its time so far this year below the 62. You can see that this is priced this year. Spent the majority of its time. The dollar has spent the majority of its time falling. But right now, I mean, for all intents and purposes, Dave, it's not as if over the last, few months or 8 months or so, it's not as if this thing has really screamed one direction. It's been kind of stable in a lot of ways.
Yeah.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.